Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Welcome to another episode of Weekly Notebook Review.
How you doing, brother?
I'm good. I'm good, man. How are you?
I can't complain.
Yeah,
just
glad
another marathon. Just another marathon evening of work and 10-year-old gymnastics.
Is that the life I have in front of me, Mitchell? I suspect so. We both my son and daughter love gymnastics.
I missed you. I must have a bad signal.
Oh, that's okay. I was just saying, both my son and daughter love gymnastics.
Yeah, this one is we're switching. We're most likely switching to a new gym.
Oh, cool.
And these go from 3.5 hours a couple days a week to 4 hours 4 days a week. Most likely.
Wow.
We haven't made a decision yet, but we'll see.
Wow. That'll be intense, but I'm sure well worth it. I know your daughter loves her gymnastics, but why don't we get into it? Glad to have you on, Mitchell. I know it's been a couple weeks since you've been able to attend, so thrilled to be able to see a lot of friendly faces out there. So thanks everyone who was able to join. We greatly appreciate it. It is a little after 4:30 on January 18th of 2023. We are about a dozen games into the year here in 2023, and the S&P had a red day, down a little over 1.5%. We are continuing to see quad 4 on the board, and that is the signal. That is what we're seeing. Keith certainly, coach, kind of shored up, was certainly sending some signals to shore up the net exposure going into the close. It's still leaning, pretty heavily tilted on the short side, so lower from here, with 5 longs in the RTA to 22 shorts. But at the end of the day, he was definitely very clear in his coaching notes. I think from the first red day, it sort of get the position. We were leaning pretty heavy here, right, Mitchell? I think you actually dropped, but that's okay. We were leaning pretty heavy short, and this was a good opportunity with some of our core shorts to sort of move them from either mid max range down to whatever the equivalent would be, right? So taking some off the board, there's a lot left to go lower in the risk ranges, but really a good opportunity here as we went into the close, just to kind of, again, there is some momentum to the upside, at least in the very immediate term basis, not even really kind of on the trade side of things. So good to kind of just take that opportunity to kind of quasi reposition the book, or kind of just give yourself a little bit of extra bullets, a little extra ammo over the next few days, few weeks, whatever it might be. The S&P certainly kept kissing that 4,000 range. I think it kind of tweaked just above it, almost got right to the top of Keith's risk range there. I think it really did. It was 4,014.16 was the high. So I think you guys all know what the top of the risk range was. It's a beauty when those fractal gods and Floki all work together. So it definitely kind of was hovering up there, and then just immediately went down to that 394 range and kind of just kept sticking around there. So I'm not an options guru. I don't really do, if anybody's got zero dated questions, you are certainly better suited to find another Spaces or another podcast, but we can talk a lot of different things like signal strength and everything in between, right? The notebook. So that 394 level seems to be kind of where it's stuck right now. And we'll see what tomorrow brings. But Mitchell, I don't know. Oftentimes trends here, and we kind of pass it to him. But I don't know if you have a better connection now, buddy. And if you do, happy to kind of let you run through some things that you were interested in going into, throughout today, or some changes from the weekend to today. Whatever you wish. I can also give a a rundown as well, but just want to open it up to you where you haven't been on for a couple weeks.
I don't know if my signal's better. Can you hear me a little bit better?
Much better.
All right. So, um, around the horn, I mean, I did a little bit of what Keith was doing, a little bit in line and a little before he was doing it. I was taking a little bit off the table on my financial short, a little off the table on my Russell short. I was adding a little bit to XLU, SPLV. I did not touch my ITA position. I bought a little XLV, bought a little gold and a little SLV. I did sell my VXX position, large in part, similar to what Keith said. You and I have had this discussion with X2. I do not like those vehicles, but at the same time, I did want to try to take a position where I could capture some of the upside from what we would have, what most of us consider the beach ball being plowed under the water. I've gotten a lot of DMs, texts, etc., from some people. Say with the anxiety of oh my God, is this the another one of those rallies? Another one of those rallies like we saw back in April of last year, August of last year, etc. I think one thing to point out to those who might be wondering if that's the case, or the signal didn't catch it, or whatever it might be. My simple point was I don't think the signal was broken on GLD, GDX, SLV, SLIV, the silver miners, the gold miners, etc. I think it's many of us. I think we want to be more bearish. We want to express that more bearish position in holdings because we see the data coming in and the data just looks abysmal. At the same time, I think we have to keep ourselves in check to our rules and our process, to not get too far over our skis too quickly. I've seen some tweets from some of us in Hedgeye Nation who have been talking about being grossly, short to the point where they're past their rules. Right? I would just caution some people on those rules. Stick to your rules. The rules are there for a reason. Even though we think that the market's about to get absolutely annihilated and smoked, and the earnings from Goldman and KB Homes and you name it, or JB Hunt, they're showing what we believe. The markets don't always have to react to that right away, especially around calendar events such as OpX with VIX options, OpX with Friday, I believe, is third Friday of the month is OpX Friday, or am I wrong?
Yeah, that's correct. It's the 20th.
So I think Friday. So you have a couple OpX events, and I think I threw out a tweet the other day. It's all over but the crying and shouting, right? When you get to points like this where you see things as blatantly as we're seeing them, they can only defy gravity for so long, in my opinion. But at the same time, it doesn't mean that you get too far over your skis. So I still think. Well, I don't think look at the risk ranges. There's still a lot more room to the downside in many of these names, but simply risk managing the positions, as you noted, we would take a little bit off the table in short positions. We would book some of those gains, as in Keith writing some in all caps, and I did buy some incrementally on some of the longs that I have that are balancing the book. I would have loved to have not been as short a day ago, but at the same time, I wasn't too crazy. I still have a ton of room too short, and I still have room to add more to the long position. So just remember your rules, stick to your rules. This market is moves that we're seeing right now, for those who have been through this for a long time, and I've been doing this for 26, 27 years now, moves like this don't happen unless you're in what Hedgeye defines as a quad four. That's what the volatility is, whether it be up or down. So, just stick to your rules, stick to the incremental movements, stick to the risk ranges. And I know that the top ends have been moving higher, but we know that that can happen from the 3 times it happened last year, which is why incremental is the key word. Incremental, patience being an asset allocation. Most of the guys, or many of the guys I talk to, like, hold on to these words very staunchly, because things like this could happen. So, don't let your emotions get over you. And I know you don't, Robert. I'm just saying to some of those listening who might have a little bit of blood in the stool.
Yeah, no, exactly. And the other thing to note, again, it's all about perspective. I mean, year to date, as of this morning, S&P was up a little under 4%, right? So with this move lower, I've got it at around whatever, got around a little over 2% now. Sorry, that's on a 1 month. So on a year to date basis, yes, it's about two and a third. So again, it's not like we're up 10%. I think Keith
Right.
Keith mentioned that this morning, right? It's like it is a rally, right? We're positive for the last month and positive year to date, but it's not exactly like it's a face ripping rally. So I am a little, again, I've seen similar tweets myself in terms of, what's happening out there. The guys are getting a little bit bigger than they probably should have, and certainly. And I know Keith, took it to a very extreme level or not extreme level. Sorry, he extended it. The list of RTA shorts was quite robust, right, to say the least, and that tilt was pretty heavy, and that happened, late last week. So it's one of those things where, yeah, I get that, but you also have to kind of understand that, he's touching those positions. Even if you put all those positions on at kind of the minimum or maybe mid sizing, when you hit the button twice, you really shouldn't. You should be seeing the fact that there's kind of some momentum coming in the interim, and we're at the kind of top end of the ranges. But then you got to kind of peel the onion back and look at where those trend ranges are. And I know they're not always provided, but that's really one of, we've talked about this a number of times, especially with Chris Moyer, who I see is listening in from the UK.
Nice.
Overlaying the XLK trade immediate term range that we get in the morning with the trend range. I'm just using that as an example, right? Because I know we have it on both sides. The trend range from ETF Pro, and that gives you a really good indication as to where those it just helps with entry, and that's So I agree. I think it's.
I think it's also important, Robert, to note everything that I agree with everything that you said, but also in the macro pro, Keith has, and on Keith has been very firm with talking about his longs, right? So, while he hasn't, and I think he does a pretty damn good job of letting us know where he is from a net short, net positioning. He was only net. I know he was net 10. He was net 14, maybe 15 at most, even with all of those shorts, because he did have the minors on. He does have, ITA, XLU, XLV. He does have some of the names in the macro pro that I won't say on here just because they're not, they're for the macro pro users, and not everybody in here might be a macro pro guy, right? So even with him being as short with as many names as he was short, he still wasn't crazy short from a net positioning perspective.
Yeah, I mean,
Am I right?
yeah, no, exactly. He takes it to, his max net short is minus 25%.
Right.
I had his max net short at minus 12.
12? Okay. So 12.
12.1 is what I had it at, but
Yep.
it basically, so it's been kind of in those low teens, call it, right?
Yeah.
So it's been low teens. So yeah, exactly. That's exactly
Yeah,
right.
I think I was negative 18 to 20 net short, and then in adding some positions today and trimming a few shorts, I came on down to maybe 15 or 14. So maybe I was a little bit more than
Yeah,
him,
no,
but
and
not much.
again,
So
like everybody can do it their own way, right? Like you can
right,
express it however you wish, and
exactly.
we absolutely see, the data as you mentioned is rolling in, and it is keeps getting weaker and weaker, and we've got
Exactly.
the Fed meetings on the 1st of February, which is in approximately two weeks. No, it's actually exactly 2 weeks, isn't it? So yeah, so that's pretty awesome. So it's in 2 weeks, and so that's on the horizon. But again, there's a lot the data that keeps rolling in. You're continuing to get data coming in from December. You'll then in about shortly after the Fed meeting, you'll start to get the data in for January, right? So it's we see exactly what's happening. This earnings recession is absolutely the data and the numbers are absolutely rolling in. You mentioned Mitchell about Goldman Sachs, right, and what they reported down 70 percent revenues, I believe the number was,
Yeah,
and
70 year over. Yep.
yeah, so it's again, the it's not even about the short dated mechanics. It's because I think you've got at the end of the day we combine the quads with momentum trading, for lack of a better word, right? So we absolutely we're trend we leverage the trend levels and trend signals and trade levels from an immediate term standpoint in order to help us with picking the best inventory that are winners and shorting those that are losers. And so again, we just have to be conscientious of the fact that sometimes that momentum from the signal, right? It's still a really hard game, and yes, it's the market's up, whatever, two and a third percent year to date, but it's also down massively, right? Going back, if you look back, even just from the August highs, right? So it's yeah. So anyway, there's a lot going on here. I think we need to the big things that I have written down in my notebook that I'd love to now that especially trends up here as well. The global rates environment to me is one that really stands out and certainly is a signal that was shifting last week and continues to maintain that signal as we have had only like two days here in the U.S. because it's a shorter week. But that's something that I really wanted to review with everybody today was kind of certainly U.S. 10-year in particular, along with kind of what's happening in the British 10-year as well. Basically Japan, et cetera, et cetera. The other thing too, and I thought this was really interesting as of this morning, was certainly oil and where that risk range was in regards to the trend line, which Keith mentioned. So wanted to touch base on commodities because I think these in terms of getting a grasp as to where we're headed, the dollar rates and commodities are really going to be key pivot or key points of interest and key points to be very aware of as we move deeper into quad four, and certainly in these points in time where I believe Chris has shared some of the quad baskets. I think I saw that from him a couple of days ago or over the weekend or something like that, and that's interesting. They kind of all came back to relatively level playing field here, aka kind of like zero returns, and yet today the quad four basket was an outperformer. It was up about kind of 14 bips versus quad one down 100 and quad two basket down 120 basis points. So today was a squarely quad four performance day, and so, yeah, so just keeping track again. Those are great ways of reviewing kind of what's happening out there in terms of overall portfolio allocations and what's
Yeah,
performing.
Robert, if we stick to our notebooks,
Yeah.
this morning circled in my notebook, I try to note top ends of the ranges, middle ends of, or if they're middle or close to the bottom ends of the ranges. And, XLK was at 131 versus a 132 top end of the range.
Mm-hmm.
ITA on the other hand, was at 111 with a 110 low end of the range, right? So we bought ITA today. We were shorting XLK the past couple of days, right? You had Microsoft 240 versus 243, 135 versus 137 for Apple. If you look at the up down ratios, they were 7 to 8% with 1.3 up. So everything that we looked at from the notebook perspective should give you a very good idea as to where things are from an up down ratio. 0.6 up to 5.1 downside in the S&P, 1% up to 8.1 downside on NASDAQ. Russell was 0.9 up to 8.7 on the downside, right? So if you're keeping track of it, which I know you are very diligently, you know that the bottom ends of the ranges based upon the moves aren't necessarily going to come up very much based upon, as you've taught me or tried to teach me, the 30-day look back kind of falls out, right? So the bottom ends aren't going to come up much. The top ends might move a little bit. So the more you have a little bit of up in markets, the more incrementally you get to the top ends of the ranges, the less the top end's going to move and the bottom end's going to remain the same. So I understand where all the anxiety was coming from, but if you're keeping an eye on the notebook and you're circling these things, keeping good tabs on it, you should have a pretty decent setup from that standpoint just by, staying in the notebook.
Yeah, 100%. The other one is XLU. I mean, that signals definitely it continues to gain strength, and Coach hit the button on that today as well. And
yeah,
I wasn't expecting that one to get the bottom of the risk range, but it did.
That's exactly right.
Yeah.
I had that one this morning at the middle of the range,
Yeah,
at
exactly.
71.3. But as soon as you see it fall off where it fell off with the move in interest rates, there you are picking that one up. So
and the other one that got started on
the
other one that got started on my side is the lower high on the Russell, right? So I wasn't really expecting that one. Certainly coming into the day, given the price strength that has been occurring in the Russell over the last sort of week or two, and that lower high really again just sort of you see that on the page, and now again it's a higher low, so that's a consolidating risk range to use the proper terminology, but that lower high is definitely an early indication or an indication of many. You really want to have you want to see kind of it positive on low volume, and then you want it to be down on accelerating volume. And
I mean, even keeping an eye on XLK though, like XLK, I think is like 7 days now where 119 is the low end of the range, right? You had a lower high on S&P at 4014 down from 4018, and then if you get into the tech complex, you had Amazon, which had, which the high was the same today. Facebook, even though that's been moving higher, the lower end was still remained 123. The higher end on Google remained at 93 for the last 3 or 4 days. 343 on Netflix is, the high looks like it's stalling a little bit. So again, as you guys push, and I would echo, I've been, since keeping a notebook a year and a half now, it's paramount if you want to look at it more from a if you want to be more strict to a process as opposed to just trying to be willy-nilly with it.
Yep, I would absolutely agree. All right, Trent, always a pleasure to have you on, my friend. Thanks for joining.
Hey, can you hear me?
I can. Welcome.
Okay, awesome.
Yeah. What?
Great. So, few key highlights. I hope everybody had a good start to the new year, and I understand that it was painful, especially for the short book with the recent rally. It wasn't as bad as the summer rally which we had, which lasted for almost 7 weeks. This one lasted just for 2 to 3 weeks. We're seeing some signs of the rally giving up steam from trend strength perspective, as well as some of the levels. But this goes back to showing, if you recall back even in August when we had this sort of frustration in the community about hey, why, it seems like all the shorts are not working and we're in the new bull run and we're in the new Fed pivot and whatever. This is almost like fifth time that I'm listening to the Fed pivot discussion from the broader crowd. And this is part of the reason why I want to emphasize two things. Number one is visual charts are very convenient when somebody wants to understand the data at one shot or when one wants some sort of representation rather quickly. Charts may not be the best way to express your trading. So, for example, if you talk to anybody in Renaissance Technologies or in any of the quant funds, they use charts only for a quick glance and not necessarily to drive their trading decisions. So, very important concept when somebody is trying to push for charts or things like that. Just keep in mind there are certain rules that you can codify out of that. That hey, on a 5 minute basis, if your stock's starting to make new lows, then there seems to be some sort of a supply and things like that. On the contrary, some people might argue that hey, SPX was rejected by the 200 moving average, so on and so forth, and it could be a self-fulfilling prophecy. So I'm not here to debate or discuss about whether charts work or not, but I just want to give a notion of that as the first aspect. The second aspect I want to highlight is again, back in August I had discussed about a concept where when market makers, the large ones, the top three ones, when they see a flow coming, be it on the buy side or be it on the sell side, they tend to withdraw their asks and bids accordingly. That's what we saw here in terms of what happened when liquidity was coming through into the market in general for all the specific names which were impacted the most by tax loss selling. And that's why if you look at both the short interest factor while doing factor analysis, as well as the worst performer of prior year factor. Both of those factors were outperforming the rest of the factors hands down for the last 10 trading sessions. So, those two aspects meant the following that number one, if you're trying to express your short, then you have to be cautious and conscious about these two factors and do the position sizing accordingly. Number two is that while creating these, depending upon your risk tolerance and depending upon how you want to express your position, you could do it either as direct short, which I believe most of community members tend to find that as rather straightforward and attractive, or you could do in a defined risk manner using put debit verticals or some other facets and options. And I understand some folks may have restrictions around whether or not they can use options, especially for RIA accounts, whether or not they can use options for their customers. So having said that, I found at least for the last 13 months that the use of options and some folks might think that I use options as my primary strategy. That's not the truth. Long time ago, I think exactly 12 months ago, I did an interview with Rob where I presented my core satellite strategy. I do have a core which has US international equities, US international bonds in form of ETFs, and then I have a bunch of satellites. So the max allocation I give to my option satellite is 10 to 12%. And that means that I don't go past that weightage. And in that weightage, I'm willing to lose almost 50% in that satellite. So those are a couple of things I want to clarify. Now, what's popping up on my notebook? I've shared in the tweet nest the the overall short squeeze basket or short interest factor. I've shared a list of stocks, about 100 plus of them in that screenshot, or however many came in that screenshot, which had more than 10% short interest and were down more than 25%. So, as I mentioned, two factors, right? Bad performance 1 year past, as well as a high short interest. That basket for 4 consecutive sessions was up more than 2.5%. So pretty much think about some of these stocks literally went up 20, 30, in some case even 100%. And today that basket was down Yesterday, that basket was kind of petering out. Friday, it was strong, but yesterday was where some cracks started emerging, which kind of indicated that the liquidity chasing these stocks is flustering. We're also seeing some fundamental outcomes. That's the next point. For example, Discover Financial Services just now reported they had a strong revenue growth momentum, but as Josh had shared with us about the charge-offs, so the story on the credit cards, especially the ones which take the risk of, meaning they're not just the network, but they're also having the issuer portion of the overall value chain, are going to have some sort of impact. And this impact will go and reflect in certain banks as well. So keep in mind, Discover, unlike Visa and MasterCard, is also an issuer, which means that they do take balance sheet risk. Visa and MasterCard are simply the networks, meaning they're the processor. They're simply closing the transaction or settling the transaction. They're not necessarily carrying the credit on their books. So Discover in the after hours was hammered down almost 6 or 8%. Today, anyways, for the day, it was down 2%. So in effect, it has gone down to almost 96. Yesterday, it closed at 106 or something. So we'll see more of that happening in specific names. I think worse impacted would be Capital One. So that's the other part popping up on my notebook. I'm still holding some underwater shorts in XRT, XLY, Edzio, SPT. That's not the one that we have discussed in the community. Sprout Social is a software short which I hold. Pool and Charter. So these are some of the names which are underwater shorts for me, which means that I'm having unrealized losses on them. I'm optimistic about the SPT one. I think eventually it will fall unless it gets bought out by Vista or by Thoma Bravo, as well as another short which is Zoom Info. In international, I covered my dollar shorts except for my yen long. So I do have yen long going. I had it partially for the event which went last night. Nothing happened. I mean, there was a little bit of pop, meaning yen was weaker, but then it started trending back again by the morning time. So within 12 hours, there was a big recovery. So that's on the international front. I am underwater with some of the European shores, specifically with Austria, as well as Germany and Italy. So those three shorts for me on international front are underwater. But I'll look to increasing probably from mid to max on those names if the signal shows me the right way. I know that from a Hedgeye perspective, uh, for them the trend has changed on those names. So I understand if their viewpoint is completely different than what I hold. My viewpoint is more from a credit standpoint. So I'm holding these put verticals, which are April or summer dated. So we'll see what happens on those fronts. So those are all of my updates, Rob. I know I didn't discuss bonds that much, but I'll pop in as something relevant comes up. Back to you.
I appreciate it. Yeah, no, good summation. And we spoke last week on Europe, and although the signal's currently kind of moving against us, right, with the DAX being a bullish trend at this point in time in terms of what we get regularly, but the European construct in terms of trying to front run that signal a little bit, there's to your point, trend, and we've talked about this a couple of times, but the credit environment in Europe certainly looks like that's a big canary in the coal mine. So, I would, I'm there alongside you, buddy, is I guess what I'm trying to say. A little underwater, though. A little underwater. But luckily, I can tread water pretty good, Trent. So, yeah, Palmer. Welcome, bud. Did you have anything to add from Trent's side of things, or?
No, I was actually on. By the way, hey, how you doing,
I'm
Rob?
doing well, bud.
It was actually on what Mitch said
perfect.
earlier. I couldn't talk at the time, and I just wanted to reiterate what he said.
I love it. Let's do it.
What he said was spot on, and we talked a little bit last week with Tim about how and when on position sizing.
Yeah.
And one of the things that Keith always says is get better. And so if you're struggling over the last week or two, then how are you getting better? It's like Mike T always says, the goal is to make money. If you're not making money or you went too early, there's got to be a reason for it. So one of the things I went back and did, over the weekend was just kind of not wholesale change, but big changes that tightened me up and disciplined me more, even in my existing rules on, position sizing and such. And had I done that, what I adjusted it to over the weekend, over the last couple of weeks, today would have been really good. Today wasn't bad. I mean, it was green day, and things are looking up from here. But it was much better than what I did in August. In August, I got my face ripped off because the world was coming to an end, and I was assured that I was correct, and it wasn't. And but when we think about full cycle and where we're at, I mean, no matter what happened over the last couple of weeks, I don't think there's anyone that follows the Hedgeye process that subscribes to all the resources that Hedgeye has to offer, who sits here and goes, the bottom of that market was probably last week. It's just not. And over a full cycle duration, we got to still get there. Even if you went a little earlier over the last couple of weeks, if your position sizing is right and your discipline's right, at the end of the day, you're going to come out of this on the right side. So that's just the thing that I think you just need to keep reminding yourself is just to be disciplined. And if you're not disciplined enough, then discipline yourself even more until you get it right.
Yeah. And one of the big things I took away there, Andrew, is you're going to hear it consistently, right? We're putting in weekend work. And if you're not doing that, or even just a little bit after market close or whenever you can, it doesn't have to be after market close. You can literally be for 35, 40 minutes in the evening, after dinner, the kids go to bed and what have you, right? So,
Yep.
put the, you can, it's not like, again, you can still watch the ball game or whatever on on your iPad or whatever it is, you still have it on in the background. You can still enjoy your time and sort of, rejuvenate, but also take that time and energy, that those few moments in the day or what have you to review, right? To review and
Wow.
Trends mentioned this a lot. I know, I've spoken many times with many folks within the community where, the journal, right? And there's a combination of the notebook and then the journal. And the journal is something that I don't do diligently, and I need to get a lot better at it in terms of like the decision making for that day. I'm quite good in the notebook side of things, and tracking that kind of stuff. But I need to get better at the journaling side. But my point is what you hear, what I'm hearing is everyone, all three of you, and many that are listening in on this, because I know it for a fact, because I have DMs from you and texts and all that kind of stuff, and there's a lot of weekend work, there's a lot of evening work, there's a lot of morning work, right? And whether you've got a full-time job like you do, Palmer and Trend, or you do this professionally, or if you're so lucky to be in my seat where I get to do this, and it's a heck of a lot of fun, baby. But yeah, no, I mean that's the point, though, right? It's like I think it's really important.
Well, and I think the overarching point that sits over the top of all of this is if you're struggling, own it and be more self-reflective of why you're struggling. Yeah. I mean, that's the key. I mean, that's what all this journaling and everything else is. It's what it's all about is, how do you get better? And, that's anytime I'm red, I don't point fingers at Keith. He didn't press my buttons.
Yeah, I mean,
I did it.
I lost the grand in options, short dated options last week, and it's like that was really fucking stupid. and that was really dumb, and I should have been better, and I should have just kept shorting rather than going to because I wasn't at my max, but I thought I was fucking really smart, and it was like I can play the other side of these like zero dated like calls that everybody that the market's got, and that didn't work out so hot. So I own that. I reviewed that over the weekend, and guess what? I didn't put on a short dated option yesterday. I put on a March option, and that's working out a lot better for the majority for this kid. So it's just reflecting and understanding. Okay, like what's your process? But I'm glad. I look forward to hearing some of those tweaks. I think that's really cool. And anybody who's doing this, you're going to keep tweaking it over time. And if you're doing that currently, then kudos. Like, well done. Keep at it, and just keep adjusting, getting better. You did say something that. But now I'm drawing a blank as what it was. You said one other thing that I want to touch base on, but that's okay. I see.
Well,
sorry, go ahead.
There's one other quick thing I just want to throw out with regard to the notebook and what the thing that was really kind of glaringly important, I thought, at the end of the day, is the dollar. I mean, we had that kind of movement today off, bad PPI, bad retail, and the dollar just kind of stayed still. If that thing comes back to life.
Good night, Irene.
Good night, Irene. I mean, it's a wrecking ball, and it will come. And I struggle to believe how it won't, especially if all this when BOJ gets tired of fucking around with everything they're screwing with, and they figure out they're just a bug waiting for a windshield, which they are. I mean, there's more pain here, so just stay the course.
Chris, you jumped up.
The one point that
sorry, go ahead, Mitch.
Sorry.
No, you're good.
Just one point that Andrew brings up, said a different way. You own your own duration, right? So that's the beauty of each individual process. I think my point was more so just stick to your guns, stick to your process. If you set your limits, just be wise to them. So that's all. I wasn't singling Andrew out. Trust me, I got many a DM.
Oh man, I never felt singled out at all.
All right. I hope you don't think so, Andrew.
I just appreciated yours. I appreciated.
No, and that was
they were spot on. I think,
and that was actually what I wanted to highlight. Sorry, thank you, Mitchell, for bringing that up. That's exactly right. You've got to understand your portfolio construction, right, and your duration, and what. And again, and your tolerance, and if your position, your decision making caused you to be uncomfortable in the last week or week and a half, then you need to reassess those decisions made, and next time you're in that situation, make it a different situation. It's just like if you play any sport, right, or you're doing anything, anything, you're building a house, you're doing whatever you're doing, on a professional level. This is a professional game. This is a really hard game. And so if you're making decisions that aren't going, that is making you uncomfortable, or that in hindsight you realize were not the right decisions in that moment of time, then reassess and try to be better and work to be better. You're not going to get better out of the gate. I screwed up in August, and I screwed up again last week. But guess what? I'm getting better, and it's all about, as Palmer said, being self-reflective and making sure that you are owning your mistakes and owning and working to get better. I had a conversation. I see David Salem listening in, and we were talking about Mandelbrot and the trend in trade lines, and and he shared some things with me that is going to make me better. It's going to make me better when I get to them over this weekend on my flight down to Miami. And so I'm really excited about that. And you just got to, again, surround yourself. This is what I don't want this to sound, it's a little bit of a plug because I'm really excited about the event, but these regional events from Hedgeye, if you're part of the Hedgeye community, and whether you're new or a veteran, whether you're running, $100,000 or whatever, $10,000, $100,000 or 100 million or 10 billion, the mindset remains the same, and the people are absolutely phenomenal to be around. And I've said this multiple times, that it's one of the best parts of these events is that you get, you bring these conversations and you get to have them in a more intimate setting and face to face, and everyone is there to help lift you up and basically make everybody better. That's why these calls are really, really, really cool. And I'm excited to be down in Miami and to have another regional coming up on Tuesday next week, and it's going to be a lot of fun. I know I saw the list yesterday, and there's a lot of awesome, friendly faces that are going to be there that I'm very excited to see and have a drink with, and talk over coffee and shoot the shit, basically. But have it focused on process, right, Mitchell? I know you're going to be down there. We may have lost him, but That's right. Well, I know, Chris, you came up when I was talking about journaling, and I know that's something that you do. I don't know if that's why you came up to speak.
Hey,
But
can you hear me?
yeah, I can.
Nice. It wasn't specifically on journaling. It was
Okay.
something. It was something I was thinking about. This has turned into a bit of a kumbaya session, I guess.
Yeah. I mean, hey, I
So,
guess it's okay, right? Like, I don't know.
but I guess yeah. So I guess we've had a red day today. So maybe that's off the cards. But I was thinking about it this morning while I was walking the dog, and a few people have said they've kind of don't have the time to to go through the books as much as maybe some people are. And I was thinking about it today, and you don't get on the football pitch and start asking questions of the players around you of like, so how do you do this? What do you do that? That was kind of my thought. And if you don't have the time to spend as much time in front of the screen or understanding the signals or, doing your own work, then, I said this when we came in January 2022. I said, if you get through 2022 at zero, meaning like no losses and no gains, you're going to beat 95% of everyone around you. And I think now is not the time to learn how to short. If you don't have the time to sit and go through the books, take what time you do have, go back on the website and start watching like old macro shows or early looks from like quad 2, let's say 2017 or early 2018 or 2021, and start reading the kind of mistakes that people were making in quad 2, i.e. selling things too early, so that eventually when that time comes, you've already done the groundwork. Because if you're coming in here now and, I'm not saying people can't get things wrong, but if you're getting if you're getting like trapped in these kind of things now in shorting, now is probably not the time to be learning how to short. That should have been like 2 or 3 years ago. That's when the reps were getting put in. So if you genuinely don't have the time to be in front of the screen and doing this, then take what little downtime you do have and go and learn how to do things about quad 2. Go back in the old stuff that's in there. Listen to like the old versions of these if you can. Listen to like our old videos that we made when that was going on and we were talking about the things that we were screwing up in quad 2.
Yeah, 100%. 100%. Yeah, because we're having the opposite conversations, right? For pretty much everyone on this panel, in terms of our speakers, in regards to things going up and not getting to the low end of the risk range so that you can buy it. I mean, we're experiencing that kind of with gold a little bit here recently, but it was like, how do I step into something? And now it's like, okay, well, it's never getting to the top end of the risk range for me to short it. So anyway, but yeah, no, you're hit the nail on the head. And then there's also a lot of folks, like I see Gavin's out there, and Jimmy's in IA, and there's many Corey. Again, I'm just seeing some folks quickly that like Corey's an investment advisor. There's a lot of great investment advisors. Other side asset management was just on Mitchell. So again, there's some really great investment advisors across the country that deploy the Hedgeye process, and they do so rigorously, and so again, if you need help trying to find somebody, to Chris's point, if you can't have the time, carve out some, if you want to carve out some of that capital and give it to somebody who's a professional, by all means, that's one option. And the other is, to your point, Chris, being flat, aka coming out of this at zero, just like in 2022, is definitely going to be a massive outperformer, and you're going to have a lot less anxiety in terms of, are my shorts up or down or what have you, or is my consumer staples performing the way that they should? And yeah, that's a really good statement, man. The website is a hair hard to navigate, and we know that, but it's not impossible. And I will say that I joined in I know, Chris, you've gone, I think you were 2018 when you joined, it might have been 2017, but I was March 2020. And what I will say from my time there is, like, if you are new, Coach did a lot of coaching during the macro show. during those kind of months during COVID, because there's a big influx of new subscribers, and for many reasons. Obviously, one, quad four, and two, just people staying at home and kind of furloughed, blah blah. But those many of those macro shows are really certainly how I learned and cut my teeth, and then going back in time and reviewing certain components, like Chris said, right? If you see on going back in history, right, if something was a quad four environment or quad two or quad three, you can go back and review. I love going through the early looks. I know, Chris, I think you're compiling some things there, but I love going through the early looks because it gives you a great I guess maybe I'm a visual guy, but in terms of like consumption, I think I'm certainly a bit more of a reader, and so I love the early looks because it can be a bit more of a condensed synopsis as to what's going on, and certainly the mentality of what is trying to be communicated to institutional investors, as well as obviously the retail investor as well. So yeah, good call out there, Chris. All right, so we're moving on to almost the hour mark. I see Gavin's out there. He hasn't joined in a hot minute. I don't know if you can talk, Gavin, but you're obviously welcome to jump up as well. But why don't we open this up here? We got a great few speakers. Jimmy, I know you joined. You haven't really said anything yet, but welcome, my man. You're out on the West Coast, and appreciate you dialing in. If there's any questions out there, by all means, please pop up. We can attack them. But in the meantime,
what's going on,
in
Robert?
the meantime, I was going to just kind of pass it over to Jimmy. Jimmy, we've talked. I know you kind of joined a little late, so we've talked Europe, we've talked U.S. equities, we've talked volatility. Excuse me. We touched briefly on commodities, but if you got anything there, we can dive into it. I know last week, I think it was last week or maybe the week before, you brought up Bitcoin and related kind of entities. That was a great call out. So well done. You've got a knack for sniffing out some of the higher beta names, Jimmy. Higher beta inventory. You got a knack for the higher beta.
This is the year
inventory. Yeah, go ahead.
Yeah, this is the year of the rabbit. So now that Playboy is officially out of the RTA long box, and people will stop asking questions about that, which Coach has been very clear about. Maybe there's a dead cat bounce or two to be had. But really, I've been just kind of following Keith, on his signals. I think with volatility as low as it has been, I've tried, especially this bounce compared to August, compared to even October, to be just a little bit more patient, give myself some ammo, and not to think that I'm going to get it right, that the first bullet is always the top, and just give myself a little room. I've tried to run closer to neutral, which is saying a lot, because in my Roth and in my long only accounts, I have, I'm bag holding some small caps, but I also have longer duration, and I have a long bias generally towards my investments there. So it's been, this last week or two, it's humbling, because we were just coming off the lows at the end of December, and now here we are looking at things like Bitcoin, holding steady at 21K. I'm probably got in a little early on the short side there, but it's not killing me. And I think 3 months ago, I probably would have been a lot more nervous, where I would have committed 2, 3, 4, 5% of my capital, and trying to be right intellectually that this is quad 4. And now I'm just being a little bit more steady. But, I'm long commodities. I'm short oil. I dabbled around that a little bit. I heard Coach talk about getting back to the short side on WTI. Again, you guys probably pointed this out. It felt right at the spot this morning. I was actually dropping my daughter off to school on the West Coast. I came back and I saw the market puked. I don't know if something happened, but maybe we just ran out of short covers, ran out of buyers.
No, there were Fed statements that came out, Jimmy.
Manu. See, now I have to take a look. I'm behind schedule from all of you guys, but my short book was thankful for that. It's been a couple of days. I'm just gonna hang out in the queue here. I guess we have a lot to talk about, but I'm back to my desk, and you know, we got earnings season now, so that's quite important. I do think that the fourth quarter earnings spin is real. I think companies typically tend to sandbag for the year ahead, and given that there's a healthy dose of conservatism baked into the buy side, if it's not in this sell side, I don't know that we see these like crash and burn type scenarios where everyone's offside. But clearly, we're going to have to, in order to get through this year, we had to go through it and all the ups and downs and all the fundamental realities that's this recession. So I'm going to stay tuned. But I'm itching for quad two more than anyone else.
Did,
And G,
Chris is right on the money.
meme I put
did
in the
Chris?
tweetness about that.
Yeah,
The meme time for U.S. equities. First time the bulls think that Fed pivot's gonna come, so they're going trying to grab it. Then the earnings come in and the economic reality set in, so they realize that they're chasing the highs. So
that's right.
no, I totally agree with you. Yeah, sometime eventually quad two will come because I know people keep saying that the layoffs are just for the tech sector and the broader economy is still having shortage of labor, but it's just a matter of time when things catch up, right? If top of the pyramid earners stop earning, this is what happened during the finance recession initially in 2007 and then 2008, where folks earning in finance almost like what the tech workers earn today, right? So where in the world does a developer earn in general outside of Silicon Valley tech $800,000 for 15 years of experience? Nowhere. It's almost akin to what analysts were making back in 2007, right? So tech is like the new finance, and if tech hits recession, eventually, their spending kind of curtails, and that kind of starts leading into or dripping into the rest of the economy. And of course, folks like Satya Nadella would say that, okay, other companies need tech talent so they can absorb the tech that we are shedding. And by the way, they started shedding their tech today. It was planned that on 18th would be the first shedding by them and by Amazon. It wasn't by coordination or anything. It was just the way they had planned out that they didn't want to let go of people during the holidays or whatever. Although some tech companies did, but Microsoft had scheduled it for like 18th of January, then next batch at 25th. By the way, that's my baby saying hello to the Hedgeye Nation.
Hello.
Trent, I was just gonna say I absolutely love hearing the baby in the background, man. It is like so perfect, in more ways than you. Yeah, it's just so beautiful, buddy. I'm well. First of all, it's so grateful that you take the time to be on at 5:30 because I know otherwise that's family time. But also just really cool to have the baby in the background, man.
Trent, your point on the tech thing is totally on point, and all my data is anecdotal, but I know a lot of my colleagues and friends, they were living off the SBC for a while. These guys came in, joined in the early 2010s in the first half of the last decade, and they've made tremendous amounts of money on their stock options and their grants, but that's coming the other way. So whether you're in finance, whether you're in tech, I went from making $250 to I made $15,000 last year, and I'm so proud of me starting my own little business, trying to get it off the ground. But that doesn't pay the bills. So I think you will see a lot of that roll through in 2023, where a lot of the wealth effect, a lot of the right sizing of some of these things that have been going on for a decade will start to catch up, and we're just going to have to digest the information as it comes.
Yeah, and just to broaden what Jimmy was saying, if people need data points, then don't go to Glassdoor. Go to this website called levels.fyi. So levels.fyi. And you will find how much does a technical program manager make, or how much does a software developer make, or how much does a engineering manager make. The numbers that they get are ginormous, meaning they wouldn't increase their base and bonus those are comparable to what a classic Fortune 100 company would pay, but the amount of RSUs that they get are just insane. Just to give you an example, uh, one of my team members quit recently because he got a job with Google, despite of what the condition is in the market. With 15 years of experience, this person got a regular base and bonus of about like 240 base with 20% bonus if all the company targets are met. Comparable to any Fortune 100 company, but the stock grant that this person got were $900,000 over a period of 4 years, not equally spread out. Google gives a slightly different way: 33% first year, 33 next. So his first year annual comp, if the stock stays sideways, is going to be humongous, almost like 550. There's no reason this person wants to work anywhere but Google, and this person is going to go from being like a people manager to being just an individual contributor, but he's happy because he's getting all that stock grant. Now, to elaborate what Jimmy was trying to explain was, let's say if you were a similar person who joined Google last year with that kind of a stock grant, uh, by the time you got vested, you have already lost close to 33, 34% of what you got in the stock grant. So out of your $900,000, you lost $300,000. In some cases, you would have also lost some money because you paid taxes when you were getting vested. So those are some of the dynamics. And Jimmy, you might want to touch upon the taxation and the vesting kind of aspect, because that would help people understand what the impact is. It's not just the jobs. When one Silicon Valley worker loses a job, it's like 8 or 10 jobs around them that could easily get lost. So Jimmy, back to you.
100%. Speaking of that multiplier effect, I got a great book. I think it's from, actually I have to go downstairs and grab it for you. It's called like The New Economy of Jobs. This was published, maybe almost a decade ago when Silicon Valley was taking off. But like for every knowledge worker, you have accountants, laundromats, restaurants. There's a whole multiplier effect to these economies where you have 5 or 6 additional jobs that are created. And having spent so much time in the real estate industry, this is probably the first time in recent history where we're looking at the other side of urbanization, the other side of this tech boom, and what it means for a lot of these former darlings of real estate. And so that's, again, some of these are more medium to longer term trends that have to be felt out over time. But again, coming back to the comp side, it's like, people lived beyond their means for a long time. And when the market was going up, you could reliably cash out of your stock grants, of your RSUs, and you were paying tax. A lot of the times, if you were working at a startup and you were giving certain types of RSU grants, you had to pay tax to get it in the first place, or it would be kind of baked into your comp where you would have to sell some of your sell some of your RSUs just to pay the tax on them. But nevertheless, if you were getting a hefty paycheck and you're getting all this bonus, you have lifestyle inflation. So then you got family, you got kids, and it's going to be very interesting to see how consumer spending for let's say the top 1/3 trends over the next year or two.
You're
Yeah, and I've
forgetting.
shared in the Twitness again the popular Seattle gym, which closed down because of mass tech layoffs with both Microsoft and Amazon. And in addition, so this is a physical gym, okay? This is not like an app where somebody's trying to. No. I take advantage of an app. That's why I'm saying, because I do have an app called Future. It's a great app, and that's an asset light business, right? Because the trainer is somewhere remote. I am somewhere remote. Where I live, I do have a gym in my, at my own disposal, so I can do it whenever I need. But this is a actual gym that closed down, and it didn't close down because of some after effects of COVID, right? COVID led to close down and bankruptcy of many gyms, including New York Sports Club that I used to go to, or Equinox was also on a almost verge of bankruptcy but got saved. So this is an actual gym that sustained during the post-COVID impact, and yet was closed down. The darker side of the RSU that Jimmy was saying, if anybody wants to get a sense of the mood or the kind of melancholy that people are having right now, there's a really great website called Team Blind. So think of it like a 4chan for tech workers, where people are anonymous but they're verified, and they do. I mean, half of that is shit posting, but then remaining half is like people literally discussing things like, "Hey, I'm about to interview for XYZ company. Can you help me in terms of like how should I think about preparing?" And these are not easy interviews, right? Also, people would think about discuss about, "Hey, what is your total compensation?" In fact, it went that fervor went to such a degree last year that if you did not, for any question that you're posting, if you did not post your total comp, people would not respond to you, or people would just literally say TC or GTFO, meaning post your total comp or get the fuck out of here, which is crazy. So it gives you a sense of how shit posting worked there. But when you looked at some of those numbers and when you cross verified it with levels.fyi, which does a substantiation, those are ginormous numbers, and that led to massive attrition of people going from non-tech to tech. And unfortunately, some of those people who went from non-tech to tech were the first ones to be cut off by the tech industry. So absolutely important. And those are a couple of resources if you want to just take a look. Levels.fyi for knowing the comp of tech workers, and Team Blind to getting a sense of the melancholy that all of these workers are living under. They're constantly living under some sort of insecurity and some sort of job threat, and particularly more so for folks who are on their work visas or something, right? If they don't have that thing to worry about, then it's working out well for them. But for folks who are on their work visa, they're just constantly under threat, and they're curbing their spend like it's no tomorrow.
Chris, I know you had a cheeky British comment, so I'm going to pass it.
No, I was just going to say, you're lending against your Google shares and buying crypto, and that's obviously not happening either.
See, I knew it was something cheeky.
But just like
that's awesome.
I haven't used. I used it for the first couple of days, and then since I've kind of been locked out. I'm obviously not in the. I'm not in the click, or I don't have the API set up properly to get access to it. But I guess one of those things is like, instead of employing 1,000 developers on 500 grand a year, whether that's split with comp and whatever else, you could just have 10 super Jedi developers and pay them $5 million each and just use Chat GPT, right?
I believe that would be an option.
Are they all? I mean, like, are all these jobs going to come back?
I would push back against that. I've used ChatGPT a lot just for experimentation, and the accuracy is not there.
I know that, but I mean, like, between then and now, if you're staring at having to like re-employ some of these people on the comps that you're talking about, you're gonna do as much as you can to go the other way, right? It's no.
Yeah, agreed. And also, a lot of that comp will be moved to low-cost cost centers, right? So, what other Fortune 100 companies do in the non-tech ones, they typically tend to go to other countries like Philippines, Ukraine, India, Bangladesh, Pakistan, wherever they could set up low-cost cost centers, right? Or Argentina or LATAM if they want the same time zone, and especially for uh, functions such as testing or automated testing, right? Like DevOps or those kind of things. All of those aspects and operational aspects are being done from there. So, for example, how did Twitter get rid of so many employees and yet keep functioning? That was because, first of all, they put curbs on their new project. Because if you look at any tech company, right, there's the build side for building new features, and then there's the run side, which is to keep stable what's already built or maybe enhance it a little bit. So most of these companies are putting curbs on their new projects at first. In extreme cases such as Twitter, they're almost stopping most of the enhancement unless it goes through some sort of governance. And for the run side, they're getting rid of headcount because headcount tends to come with a lot of benefits, typically the multiplier is at around like 35%. So if the total comp is $100, then they have to pay 135. And to answer your question about ChatGPT, I think ChatGPT is simply a representational tool built on top of decades of artificial intelligence, which is built out by Google. So specifically, if you see how Bing is created, Bing was created on top of Google because they couldn't be as accurate. They couldn't get that level of relevancy, etc. So ChatGPT is simply an application which is giving you a good representation on top of that uh, indexing which Google has done, or the uh, or the uh, or the decades of neural networks and the accuracy that Google has built. So I think from a standpoint of Google being replaced, it would be different. Uh, to to answer your question specifically, or rather comment specifically about the replacement of developers, I think in web scale companies, the kind of skills that are required are very different than somebody trying to do a scrappy startup. So if somebody's trying to do a scrappy startup, for them, ChatGPT is an extremely good tool, which helps them to get pieces of code from across the web in order to build out their websites. But when you're building web scale companies such as Google or others, ChatGPT is difficult to help them. So if there were any sort of jobs which could be replaced by ChatGPT, I think these people get pipped out anyway. So PIP stands for the Performance Improvement Plan. Especially in places like Amazon, that's a very big culture of pipping out performers or people who are mishired, especially during this type of economic cycle. They would pip them out constantly, even regardless.
Who would have thought that we'd be talking developers and ChatGPT on the Weekly Notebook Review? But I am bloody loving it right now. Thank you, Trend and Chris, for both your comments. Jimmy, as always, it's a pleasure. Arthur came up. I have a feeling he's going to talk HYG because he's the HYG man, or becoming to be well known as such. But maybe he's going to surprise us tonight. And then I do have two questions from Twitter that I do want to touch on as well. That I think the panel is going to be it should spark some good convo. But Arthur, welcome. Always a pleasure, buddy.
Hey, thanks for bringing me up. Can you hear me?
Yes,
Okay,
we can.
cool.
Absolutely.
I just want to make a comment. Bring it back to today. Don't ever, at least I don't ever underestimate the market's ability to create a new narrative. Okay, never. Had a good day, but if you weren't following Keith today in the process and covering some shorts and getting into some longs, that's incrementally based on the risk range and based on the quads and the assets that pertain to those quads. That's the flow. And someone, I jumped on late, but someone brought up the analogy of a sports team. It's kind of like football and rhythm. I mean, when I'm trading my book during the day, I can get out of rhythm or I can get in a really good rhythm. I mean, and today was one of those days. They don't happen every day where, where's volatility? What bucket are we in? Okay. Don't ever underestimate the ability of this market to come up with something to protect themselves one way or another. I mean, there's 5.2 million puts at 390 max pain. This market's not going to crash until those puts are taken out this week. So you gotta just remember the basics of the process, and I will never cease to be amazed, say it for the third time. They'll come up with something. I don't know what it is. No one here probably knows what it is. It'll be some narrative about something. And they'll run this thing, just like they did in 22 a half a dozen or more times. So stick with that process. Today was a great day. I was covering, I was adding cores, minimum, and just if you can keep in that zone, and it's literally a zone, we're all going to do really good this year. That's all I wanted to say is make that comment.
No, awesome comment, Arthur. I'm gonna.
I just wanted to add on that, Rob, if I may.
Yeah, go ahead. Go ahead.
Yeah.
No,
So real
that
quick,
was
I
great
wanted to add
commentary.
today, to add to what Arthur said. Mark Good has made an interesting comment at the 12:30 p.m. Eastern, session which he had with the retail team, and it was an interesting comment. He said that short selling is not for everybody, right? Because you can get absolutely destroyed in short selling, and that's absolutely true. Because what sometimes may happen, and Keita shared his experience with shorting Reebok and the bloody company getting bought out, leading to a pretty significant hole. No matter what position sizing you do, let's say if you had the short size at 2% of your book, and suddenly somebody comes in at a 50% premium, you have a 100 basis points hole to plug. Then you have to find five other ideas that will try to help with that. So sizing the short side is not easy. And I'll share my experience with similar experience with another stock, and that was Netflix. This was when Carl Icahn jumped in to save Netflix. He bought a whole bunch of stock through calls. The stock started ripping because it was a short covering, and it had reached almost like 100 plus levels, which is different compared to the 100 today because the stock got split several times. But at that point of time, I was dead sure this stock is not going, above. And lo and behold, I was wrong. I held that short position for almost 7 or 8 months. This was a long time ago. I think this was somewhere in 2014 or 2015. And it started at just like 50 basis points of the portfolio, but it quickly became like a 150 basis point hole because the stock literally tripled from there. So just wanted to share similar pain point like what Keith shared about Reebok, that short selling is not for everybody. And since then, I've evolved my mechanisms to go short. I try to use put debit verticals mostly with some time on my hands. So that way, eventually, when the market moves as well as position sizing wise, my risk is defined. So just wanted to share that with everybody, and building off of what Arthur said, that if short selling is not something, and also what Chris said, right? If short selling is something which you haven't done in the past, this is not the time to learn. Maybe you might want to learn about what's coming up later on the other side. Back to you, Rob.
If I can just jump in quick, I mean, and another thing to
Yeah,
add on to
please.
that too, Trend, is, I mean, if you're going to get into the game of having a long short book and you're going to have some shorts, it should be half the size of your longs. We know all the basics. I mean, I hope some of us are still learning, but that's one of the basics. You get a profit on a short, I mean, you take it. I mean, you just take it. I mean, I've seen Keith a few times. I've been around this thing for over a dozen years, and in this kind of a market, I can't remember what he covered today, but something. I mean, he actually had very, very small, but even a tiny loss on it just to move the inventory because he saw something better. And to hodl a short is just, you're just putting a gun to your head. So you got to keep the inventory moving all the time if you're running a long short book. And if you haven't got the time or the experience or whatever, then I would highly recommend just don't do it, or do it in a paper account until you can see, the kinds of predicaments you can get yourself in. It took me a long time to get to a point where, that I could move and keep in that flow, and make decent money running a long short book. So I just wanted to come in and say that because today everyone's, kumbaya, big down day, shorts are working, blah, blah, blah. Time out. We're still in the chop bucket. And again, I don't know what it'll be.
Yeah, I mean the VIX closed at 20 and
Yeah,
change, right?
yeah.
20 spot 33. Like, yeah. No, we're definitely not like this is not 30 F, but this is not 35
No,
VIX
that's a whole,
in
and
the F
right, and that's the
bucket.
key thing there too, Rob. If it was
Yeah,
up there,
No, that's when our shorts are
there
gonna be
you
up like
go.
40%. Yeah,
Absolutely.
no, like
Okay.
20 15%.
Okay, I'm good.
But yeah, no, that's going to be like, hey, let's pop some
There
champagne,
you
Arthur.
go.
This is just like, hey, this is everything's cool, right? We won the fight, or we won the game. Finally won a game after a couple day losing streak, right? A couple game losing streak. But don't, Arthur, please don't, if you don't mind. I'd love for you to stay up here for a minute, or for a little bit, because this next question is a good one, and it's a great segue. It's from Investing Perspective, and the question is, what do you think of shorting FEZ, so Europe, and Ulta? Coach does not like it given trend. Now, I'm going to expand on that and say he doesn't like it because of the trend signal. Both of those are I believe, have shifted. At least Ulta, he said on the call today, was bullish trend, and I believe FEZ as well. We could dovetail that to DAX, just where we know that is bullish trend. But I would love to kind of propose that question to the speakers on here in terms of, okay, if really those two are kind of like fundamentals or longer term, we see the data on the horizon that would indicate prices going lower. However, near term momentum and the signal is against you. So I actually really love this question, because we've got Trent and Chris, who both kind of approach things from definitely a signal perspective. And then I think this is a great question. So Palmer's got his hand raised, and I'll go to you first.
With regards to Europe, I just see this as kind of a counter trend rally. I know Keith's signal has changed, but I'm struggling to see how, if we're looking at job losses here with the inflation or cost pressures we've seen, how in the hell Europe is going to magically end up in a bull market is just beyond my belief. And I use leveraged ETFs. I'm max position EPP, and I'm down a little bit on it, but I don't really care. I'm holding on to it right now. So,
Hey, you guys, we're sitting in a bar. There's a bunch of there's half a dozen women there, and you're a hot guy, and Europe's the ugly one. Okay, why go there? There's so many. That's the thing about Hedgeye. You got a global go anywhere strategy. There's so many things to do out there. I appreciate the question. I would look at, obviously, the signal is, in my mind, the most important thing. And, you got to wait for that to get in a position where it's, changing, out of bullish. It could be a fake, signal there. We might get a neutral within, who knows? And it could happen. You keep your eye on it. But to do anything there today other than just watch it, I'm going to go get the blonde in the corner with the big blue eyes. So that's what.
That is a perfect analogy, and exactly that's where I live in terms of that right. It is a good question, especially for somebody but the signal trumps everything else. And Arthur, you're spot on there. And I think and that's exactly right. There's just so much other inventory that is actually bearish trend, that you can, and that's been at the top end of the risk range. And therefore, you've got a lot of again, like REITs is a good example, right? It's been bearish trend. XLE turned like neutral in the last day or two, but that's been we've talked about XOP on here on this call. I think that was even last week, and there's just so much inventory out there that why go bang your head and try to almost be intellectually right. Again, I do think I do have some Europe shorts on, but those were put on when that signal remained kind of at least bearish from what I was seeing. And then and I just haven't, I kind of I personally like giving it a little bit of time and space to sort of either confirm this bullish component, right, in regards to again, just like a couple of days of DAX being bullish trend, which I know it's been a couple of days now. So I am kind of like transitioning a hair on the European side, but I do have those on currently. So I kind of sit a bit in Palmer seat, and I know Trend earlier in the call, he said that he's got some European shorts on as well. But the signal is changing, and you can't just ignore that. So there comes a point where sometimes you just got to take those losses. and reposition, because you might be able to get, better pricing down the road with a different signal, or you just go pivot to something that's actually going to, make you, potentially make you some money with better or weaker signal strength, aka bearish trend.
So I'd like to bring two quotes here. First is, you're in the market to make money, not to be right, right? And then the second one is that the markets can stay irrational more than you can stay solvent. So I don't know who originated both those quotes, so I can't really reference the original authors, but definitely
Two great
something.
quotes, though.
and relevant to this question, right? So
Yeah.
at some point of time when my threshold for those Europe short options, put vertical options that I have, get triggered, which is typically 50% of those positions, I'd be just completely clinically getting out of them, not necessarily building on that position while the signal is bullish. The second part is, I also want to share a specific research material on this, which was done several decades ago, which mentioned about the fact that when Pharma French came up with their famous three-factor model, there was one more gentleman who got added to that Pharma French list, and they eventually added the momentum related factor, that along with your fundamental aspects and the fundamental factors that you have, momentum, if you add that, then that helps you in terms of enhancing your alpha. So of course this was done a while back, and that alpha has whittled away because it's popularly signaled and everybody knows about it. But today, the factor game that is played is kind of much more dynamic and advanced than what they studied in the markets from the 70s and the 80s. So, what I wanted to definitely add is, this is also, Rob, this is also in the Hedgeye University, right? That the signal also should be there, because that is the behavioral aspect. So,
Mhm.
I wanted to just request the gentleman or lady who asked this question about just checking out Hedgeye University once again, trying to check out about this behavioral aspect, and then eventually deciding that, okay, if you want to go Alta and FEZ positions, which is counter trend, meaning not counter trend price action, but counter trend in terms of what they're trying to do. They're trying to fade the price motion. Then is that the best opportunity that they got? Because there's almost 8,000 plus stickers, right, which they can trade, and something, if you apply the fundamental filter, it would come down to probably like 10% of that, maybe 800. And if they apply fundamental plus the signal filters, then it might come down to like a 150 or a 200 kind of a bucket or basket. I think that sounds like a more plausible or more sane strategy, instead of just trying to fade the new highs. And the third point I wanted to add was, when something is making new highs, there are these breakout traders who have proven trend strategies, right? Trend following traders, they just buy the new high, especially when they break out at some specific threshold, say 100-week new high, 200-week new high, or 100-day new high, with a 5% stop loss. So there's an army of these CTAs who tend to chase some of these new high sort of situations. So you need to be aware that the flow might be against you sometimes when you try to get into these kind of fundamental fights. So fundamental is one aspect, but you need to also be conscious about the behavioral aspect, respect the signal, and then explore other opportunities where everything is aligned for you. Back to
Yeah,
you.
let me just play this out a little bit, Rob. So, for the person, let's say the DAX or EWG's at the top end of the range, and Europe's been a good short, but so you took it and you're shorting it, and all of a sudden, boom, you find yourself losing some money, and it made a higher high. What I find, I mean, what I would do there is I'm out, okay, because yeah, you can still hold it and hope, and maybe she'll come back and all these things, and relevant to what Trent just said, these momentum traders and stuff. I get that off my books. I'm not looking at it anymore, and it's gone. And psychologically, and behaviorally, it just puts me in a better place because there's a lot of things to do. So I just wanted to kind of throw that in there as a way that if something doesn't go your way, and of course now it's changed, signal, gone to neutral. Um, uh, Still, it's just I just find that like Keith had one today. I don't want to look at that one anymore. I mean, that's kind of what I'm saying. That I think it was the VXX or whatever. He doesn't like that one. Yeah.
Yeah.
So I mean, that would be my 2 cents. Is and if you feel, for whatever reason, I shouldn't use that word, but you made a mistake, just get out of it, move on. There's all kinds of opportunity. One thing I learned, it was kind of hard to learn, is there's always going to be another opportunity. Always. Oh, there you go.
Yeah, I think Keith often says, and it's pretty common knowledge or common phrase, but a small loss is better than a large loss, right? So, if it's just not working for you, if you just whatever, it's good to just kind of pivot and move on. I did that today in PSP and in private equity. I put that on, mid to late last week and broke even on it. It was literally 0.00 on the trade, but it hit my stop loss yesterday, I think it was. So there was a portion of the trade that was a loss, but the other half we came out break even, and so it is what it is, right? It just was poor timing. I had it in there, and it again, it's whether I come back to it or not, or I just pivot to somewhere else. But that's one of those things where. Exactly what you said, Arthur. Right? It just needed to get off my book. It was like minuscule amount, and it wasn't working for me. And just get it.
Well, Robert, I don't want to let you down, but I got to say this, okay? HYG's not been working for me, okay? And I covered some today. I mean, it was up today. The market tanking. Going into earnings recession. I mean, I don't know how the hell these people are going to recapitalize their debt. I mean, for 3 times the price that they're currently holding it for. I mean, it's a no-brainer, right? Guess what? You know what? I took a little down today. I took some down today. I'm just not going to, I'm not going to have the kind, because, I've got a pretty good position in that thing.
Yep.
Timing is going to be critical. I think, you heard the saying, risk happens slowly and then all at once. I think that's the kind of asset where that's going to happen, and it might not happen for 6 months, might not happen for 9 months until we get the GDP and stuff, and you get the April first quarter results are going to be terrible, a lot worse than this fourth quarter. Get the GDP, according to the nowcasts, negative, down a couple, 2, 3. I mean, okay, so I'm rolling those out. I'm not, but I did take some off, and I'll roll them out. But there's an example right there.
And to that effect, I do want to build on top of that, right? There are a few factions within the investment banking industry. If everybody saw in investment banking industry, business was down more than 50%, 50% across the board, right? Without any exception. Be it Jeffries, be it Lazard, the smaller ones or bigger ones like Goldman Sachs, which is, laying off people mostly from investment banking and their platform business. The reason I bring that up is somewhat in a collusional way without really talking with each other, but by signaling, these folks, especially for Europe, started, signaling easing sort of situation, even though the central banks of both US as well as Europe are saying that we're going to tighten further, had spread the air that they wanted to, they're seeing less bearish scenario. They're also spreading rumors. So specifically, if you look at HSBC and Goldman Sachs, of all people, they suddenly changed their rhetoric around Europe towards being less bearish. Also, if you heard Jamie Dimon, he was kind of more constructive and less bearish. This is not with an intent of any sort of Fed pivot or anything. It's because they're extremely lucrative business of investment banking, And I'm not talking about just the equity IPO where they charge 7%, but even the debt side, they're unable to have good issuances. And suddenly, voila, if you saw the first 10 days and first 10 calendar days of January, Europe suddenly had record issuances in bonds. Now, what are the odds, right? Their sells, and there's supposed to be a firewall between their sell side as well as their uh, investment banking side to not influence each other. But this is clearly, happening. We're seeing that, and I'm not here to create some tinfoil conspiracy theory sort of a situation, or trying to spread that. But it's an interesting data point to observe that who does easing monetary, not monetary, easing conditions in financial conditions mechanism help? It is primarily the investment bankers who want to issue debt. And Arthur, to your point, you don't know how to time that HYG or JNK debt spiral situation for some of these companies. So definitely, it happens gradually and then suddenly, as Mark Twain put it, with respect to losses or with respect to risk. And from that standpoint, I would say that something to watch, but when the momentum or the signal accelerates, that might be the great time to act. Or you could act by having really long-term options in these, and constructing that position in that fashion instead of having direct shorts. Because keep in mind, HYG and JNK, JNK at least gives out monthly dividends. I don't know about HYG. I haven't looked at its dividend schedule, but JNK literally gives out monthly dividends. And what that means is that there are these dividend stripping funds, event driven funds sort of, or special situation funds. They tend to jump in a few days prior to dividend, tends to drive up the price, and then they get out right after the dividend. Or they'll get out even on the day of the ex dividend, just before the ex dividend, so that way they're not really capturing the dividend, but they're capturing the run up in the price. There's those two categories of folks who are jumping in to do that. So wanted to make everybody aware that there are some of those flow mechanics happening, some of these issuances related incentives that some of these banks have in order to spread this sort of an air that, hey, we're going to have easing financial conditions. Back to you, Rob.
Thanks,
I
buddy.
just go ahead.
Just quickly, if I could, just to take it back specifically to like Europe, is I don't know when Keith started changing how he talked about things and talking more about inventory, but like if just as an example in EWG or whatever, I know Keith always talks about basis points of capital and stuff, but if you've lost $1,000 or $10 or $100,000 in EWG, it doesn't mean you have to make that $100,000 back in EWG. It's not like, right, EWG is just my game now. Like, it's hurt me, so now I need to get it back. It's just a bit of inventory. That's all it is. It's just a position you took, whatever the reason was that you took the position. We're now, whatever, 5 days, 10 days, 100 days further along in the game, and the reasons are different now. And everything's probabilistic. So you have a range of probabilities around the quad that then compounds with the range of probabilities around the trend of the individual asset. And then once either one of those changes, your outcome changes because the probability changes. So yeah, that's it. Like, something's changed. It's gone bullish. So like that's it. If people talk all the time on the arena about stop losses and things like that, and well, the trend's changed. So for me personally, like that's a stop loss. That's it. It's bullish now. So if you try and, like I said, taking it back to the start of my comment, if you're now trying to beat EWG as that example by trying to short it because you know in inverted commas that you're right because, hey, we're in quad 4, well, your distribution of probabilities is completely different from what it was 5 days ago.
Yep. Math doesn't lie. No, it's a really good point. And the yeah, and for me, so you use trend, which is perfectly a-okay. I use percentage, so I typically put my stop loss around 12%, but the trend will absolutely impact that. So I'll I've moved that significantly lower on pretty much all European shorts because of that trend change in the last week. Because I just want to give it a little, as I mentioned, just want to give it a little bit of time to breathe. But to each their own. That's why it's the process.
I think as well, when I know you said that earlier about giving things space to breathe, but Keith does that too. So he said he gives things 2 or 3 days. So if it's the DAX, if that changed trend, then Keith's already given it 2 or 3 days. So if you give it another 2 or 3 days, then we're like we're a week down the road now. And looking at some of the crazy shit like up until today that moved, how much they moved in a week. You know, that bullshit bullshit basket. Some of those things were moving like 30% in a week. So
yeah, that's a good point. It's a good point. All right, Chris. I guess I'm out of Europe tomorrow. But no, that's a really good point. It's a really good point. And yeah, you're seeing me. See, this is conversations with Chris that often happen, but typically they're on a 101, and he'll just like say something, and then I just start thinking about it, and I really just go quiet, and then he's like, "You still there, buddy?" I'm like, "Yeah, I'm here. I'm here. I'm just thinking about the comment you said." That was good. Awesome. Okay, so I'm gonna have to noodle on that later tonight because I clearly should be changing my positioning on Europe. So the last question, again, I know we're pushing almost an hour and a half here, or a little bit more than that, but last question's around notebook setup, and this is from Grant Percy, good friend of the program, and he was asking kind of about visual setup. Chris, I know you and I have talked about notebook setup, and really the comment that we always go back towards is just start. The setup's going to be different for everybody, but I didn't know if either of you three kind of had any kind of commentary around that. I did a beginner's guide, I believe it was 2 weeks ago, in terms of to start off the year. I kind of walked through a lot of the different kind of items that I roll through from a data standpoint. So that's a good general video to review. That would have been episode 7 of a beginner's guide in regards to kind of a lot of the data that goes into my notebook and that kind of thing. I didn't specifically go into the setup of my notebook, but again, the question is around the setup, but I always lean towards the fact that it's kind of a personal situation. But again, I'll let you three perhaps comment. Arthur, do you track a notebook pretty diligently, buddy, or is it more like journaling, trading oriented?
I don't know if you call it a notebook, but I mean, I think it's important, if you're following a process to I'm pretty disciplined, right? So every morning, the cup of coffee, start off with, early look and the call and et cetera. And I look for real unique or things that jump out at me that's happening either during the call, whether it's an individual stock thing or just a comment that Keith makes, and on the macro show, the same thing. I write down the top 3 things, write my comments in each one of those, and then pick up on things that Keith is really calling out during the macro show. And I fill that all in. I think the most important thing is to make sure you've got a highlighter and you keep the notebook open in front of you during the day. That's about all I do.
Yeah, I think that's a great commentary. Chris, I know yours is more on the internet, but Chris. I know
Chris, go ahead. Finish your point.
No, I was just going to say, I know he's a bit of a jarring character for some, but I kind of stay with Jordan Peterson on the fact that I'm reticent to say even a bad rule is better than nothing, but that's kind of the way it is, right? It's like, just start doing something and then you'll know whether it's right or wrong, because if you give up doing it, then it's probably wrong, and you need to change it. It's no matter what you do. I guess Gavin's on listen, but nobody starts nobody starts as an artist, as a painter, by painting their best work the first thing that they do, right? It's and like anything, like bands, oh, it's an overnight success, they've got to number one, and it's like, yeah, but they've been playing to like 5 or 6 people in bars, like, with things going on in the background in front of 5 people, you know. So just like, to that point, like, just start doing something, because that's the only way you're going to figure out what's right and what's wrong.
Yeah, and what Chris is defining is focused on systematic trading. So, absolutely essential to have some of those rules. And eventually, there are two ways in which you can validate whether your method is working or not. One is by empirical evidence as you go along. Second is, if you have the time and the bandwidth, then you can back test it. I know Chris does a lot of that in order to check it out. If you don't have the time and bandwidth, and if through empirical means you want to find out as you go along, uh, there's a less risky way in terms of doing it in a paper account, trying to understand whether it's working for you or not, in parallel with your regular strategy or with your way you're doing it. So that would help you evaluate that as compared to your current method. How does this other method work out? And I run my overall book as a multi-strategy book, so I don't have just one strategy in play. There's multiple strategies, partially because every regime demands a different set of strategy. And one should have a large playbook of strategy, just like how in football, when you're in the last 10 yards and you're trying to get something done, you have different set of strategies. When you're at the start, you have a different set of strategies. So similarly, having a large playbook of strategies and getting some sort of intuition around how do those strategies work, in which regimes they work, you can cultivate that through journaling as you go along. So if you can't do backtest, then you can cultivate something like that through your trading journal, and just tagging your different trades with, hey, I did this trade because of this strategy, or I did this trade because of ETF Pro, or I did this trade because of say RTA. And then the counter trade for that, so the closing trade for that, you can put some reflection in or have some tags in it. So later on, you can run reports that, okay, RDAs don't work for me because I'm a bit late to respond to them. And maybe I need to improve how quickly I can respond to them. So maybe I need an app which will alert me immediately, meaning Hedgeye does have an app, just so you know, and you can get an alert. This is actually practically from my own learning I'm sharing with you, that few years ago, these things used to come in form of an email. So when the app was launched, I was like, wow, this is great. It helps me rectify my challenge with the time when the email comes and actually when the execution goes in. And this is called as the execution cost, right? So the execution cost, when a PM tells the trader that, hey, go long this or go short this, versus when the trader can get to enter it, it's actually measured in the professional world on the buy side in specific ways. Uh, Traders tend to be just folks who can execute well. They're not PMs. And PMs don't do the actual trading or execution work. They always have somebody who will do the execution work for them, because there's metrics in it that, did you buy this stuff for a period of time for me below VWAP, right? Did you buy above VWAP? Did you have to chase it? So on and so forth. There's a bunch of metrics which you can learn about later. But the execution cost and all these fine tunings which you can do in your process, you can tag most of your trades with variety of tags, and then come up with some sort of reporting that will help you with you know fine tuning all of these aspects. So step one, as Chris said, start with something where you can develop an intuition. Even a bad rule is a rule, right? Doing something without rules is a classic rookie mistake for traders. They're doing one thing, then it doesn't work. Emotionally, they feel bad about it. They switch to another strategy, they switch to another strategy. So they keep switching strategies and eventually not realizing which strategy perform how over a period of time. So you can run those strategies in paper accounts, or you can do backtests as whatever you might be able to do, and then that way you can get an intuition what works for you in which regime. Back to you, Rob.
Yeah, those are three great answers. Again, I'll stick with what I said at the beginning, which it is personal. It really depends on what you're trying to track and what is influential into your decision making. So, kind of piggybacking off of all three of those, Arthur, to your point, my notebook is absolutely always, open and in front of my, like opening on the desk in front of my computer, right? So I can constantly reference it. I'm sure you've heard me flipping from page to page on this call many, many times. The content there, it's pretty, I keep it really consistent on a day-to-day basis. It's the writing down the risk ranges, then notes from the macro show and other commentary, like Arthur said, in terms of the top three things. And then on the other page, it's stuff that's sticking out to me from a market dynamic standpoint. So, sector performance, volume, excuse me, the different components within like volatility, what's happening there, what's happening on, the eyeball table, anything that's jumping out from that standpoint. And yeah, it kind of goes down that list in terms of like basically my morning work in regards to what I'm seeing in the global markets. I think if you're kind of trying to get a gist as to when you're going through that process, what should be, what not should's a tough word. What is likely important or what components could be worthwhile to note in the notebook in terms of impacting or bettering your decision making. Keith often does the morning kind of tweet storm that is global macro in nature. I would absolutely start there. I think if you start there and you start following, kind of a lot of the components that he's putting out, and then as you get better, you should really be not necessarily front running that, but certainly as you're doing yours. And this is how I kind of did it. Is I reviewed that. That's my first introduction to Keith was via his tweet, kind of morning tweet. It was sort of a thing that and then I discovered Hedgeye, and then things took off after that. But I would purposely not check Twitter for an hour or so, and I still do that. And so when that way, I knew that as I was going through my prep work in the morning, was there something that I noticed that Keith didn't mention, right? And so at that point in time, it's like, okay, well, is there a reason for that? But then maybe he would cover it in the macro show, and then. But then there's other things like, oh, I missed that XYZ kind of call out from Keith. I don't know, just call it oil or something. And so, yeah, so that's a great way to start, right, in terms of like your morning prep work. But, I can put together a beginner's guide or something like that and do a little bit more streamlined approach or what have you for everybody. But no, it's great getting, Trend and Chris and Arthur's components there and their view. So thank you very much, guys, for doing that. I really, really do appreciate it. And I think with that, we'll call it a wrap here on a Wednesday night. Thank you, Chris. I know it's getting quite late there in the UK. Trend, we'll let you get to your baby and family. So thank you, Arthur, as well, and everybody else who spoke, Palmer, Mitchell, Jimmy, et cetera, et cetera. So thank you, everybody, for jumping up. We'll be in Miami next week. My flight's actually at 4, so we may need to kind of move things around next week and make a pivot. So we'll take a week off or move it to Thursday. I'm thinking we'll probably just move it to Thursday, 4:30, and just do it like a day late. So apologies for that, but just with my travel time and things like that, I'm noticing that folks seem to prefer it after market hours or kind of, in the early evening, that kind of thing. But I'm just not going to get in on time. So I'll keep you guys all posted there. And again, thanks for a great evening. This was a really solid conversation. I just tweeted out that I thought this was probably, I would almost guarantee that this is the best conversation from investing, trading, risk management out there on the internet today. And so again, this was just kind of to me, an old school weekly notebook review session where we bounce around topics, and hopefully you guys all enjoyed it.
Thank you, everyone.
Thanks, Rob. Thanks, guys.
Yeah, cheers.